Good afternoon to everyone. We'll be wait for a couple of minutes to start the session. Good afternoon, everyone, and welcome to a knowledge series on ASK products. As a part of the knowledge series, today we have with us Mr. Kuldeep Gangwar, the portfolio manager of ASK India Vision Portfolio. To welcome to him, I would like to tell he is having a total 17 years of very rich experience, including more than a decade. Is also having a sell side of research. Prior to joining with ASK, he has worked with the companies like HSBC Securities and Capital India Limited on the research analyst. He's also worked with the company called Tata Motors over the 3 years perspective. And he is a IIT from Bombay and the BTech from IIT Roorkee. He's also a CFA charter holder. He joined in the ASK exactly in 2018. Welcome to Kuldeep. Today, he is taking us about the India Vision portfolio. Before that, he will touch upon the his views and the market and the way forward. Both followed by we'll have a Q&A session of the from the chat box. We'll discuss. In the meanwhile, whoever have a questions who would like to ask, we request you to put in the chat box. We'll call it and we will pass on it to the fund manager. Over to Mr. Kuldeep.
Thanks, Suresh, and good afternoon, everyone. So, first, the backdrop amid which we are working. So, most of us are reading, listening the negative news that inflation running quite high. It's among the highest in last 40 years. Economy is progressing towards recession. There is war in Europe. There is high global debt. Weather is having its own, say, volatility, and climate change are having implication for, say, agri, aging population, and deteriorating relationship. So, multiple sources suggesting that there's a lot more going on, and which is not good for the equities. But equity is all about future, and we have to see where we stand today. So whatever we have discussed so far, it had been the news since last year beginning. We do believe that worst is behind. Fed has already increased close to 4.5% in 11 months. It's one of the fastest hike which we have seen in the history of US. We do believe the inflation is sticky, but at the same time, the drivers of the inflation are turning and the peak inflation is behind. Interest rate itself will be coming quite close to its peak, and incremental hikes will be relatively quite moderate one. If we look last year, calendar year, it can be seen in two halves. In the first half, the commodity inflation was there. Crude oil moved to close to $120 per barrel plus. Metals inflation was there, agri commodity inflation was there, edible oil inflation was there. In the second half, the things started coming down. So probably we are on the right track, and inflation should keep on coming down. The pace will decide the incremental hikes which are being required by either of the central bank. As I mentioned, that the crude oil is already 33% down from its peak last year. Freight index is down almost 88% from its peak, which should help the commodity prices. Food price index is also down. And when we look in sum total, then inflation has come down from close to 9%, last year end, to close to 6%, 6.5% now. So worst is over, and probably we are moving in a right direction. Amid this environment, if we look the economic growth trajectory, we generally come across that developed market will be either having slowdown or recession. In that backdrop, if we look India, it's going to have one of the fastest growing economic growth this year. And not only this year, probably this should hold true for next 5 to 10 years as well. Like, we are going to be one of the fastest growing economies in the world. As it happens that when a lot of negative news around, it's having implication for market multiples, and Nifty valuations have also come down in last 1.5 years. From its peak, it is almost 15% down, which is providing an opportunity for the equity overall. This was about global backdrop. If we look about how the Indian economy is doing, so while we have gone through the negative news in last year, calendar year, that there is external account under pressure because of the higher commodity prices, particularly crude oil. Our trade deficit widening, having implication for, say, current account deficit. Forex reserves came down from its peak in September 21 of $642 billion to almost $525 billion last year end. Again, there is change of event and it's inching up. Point we want to highlight, even for domestic economy as well, probably the worst is behind and things are progressing in a right direction. When we think about crude oil prices, what we have faced last year, we have faced 10 years back as well. Like, crude oil prices moved $100 per barrel 10 years back as well. Only the difference is that at that time, our IT export used to be relatively lower number. And that's the reason the gap between, say, oil import vis-a-vis IT export used to be quite huge. As we speak, IT exports are doing well, and it's providing cushion to overall current account deficit. And therefore, we do believe either in FY24 or in years to come, probably economy trajectory is going to be much better. It's going to be a lot more stable because we have this particular cushion available to us. If we think about, say, report on ground, so our GST collections are progressing quite well. We have hit more than 1.4 lakh crore for 12 months in a row. PMI also suggests that manufacturing is doing well. Credit growth has also picked up. Like at the system level, we have experienced almost mid-teen and higher growth last year, which augur well for the overall banking system. So domestic macro situation is that we are going to have relatively lower burden from the food and fertilizer, which is going to provide some physical room for the capex in FY24. If we think about manufacturing cycle perspective, we are discussing about China +1. We are also discussing about Europe +1 as well. Like governments, companies, everybody is looking for alternative. And probably India is best placed to capitalize on those opportunities. So sectors like chemicals, engineering should benefit out of it. Government itself is giving a lot of push to our local manufacturing through Make in India, self-reliance, and the PLI incentives, which is going to provide a thrust to our overall manufacturing sector contribution to the economy. And from, say, banking system perspective, probably it's one of the rare situations where the balance sheet for the households, corporates, and banks are in pretty good shape. Net, we do believe India is well positioned to capitalize, say, the opportunities coming its way, not only for upcoming year, even for years to come. Probably the decade belong to India, the way we will put it. In that background, India Vision portfolio, how this particular portfolio is being placed. So first, a brief about the India Vision portfolio, what it's all about. It's based on the value migration theme. Value migration occurs when there is a disconnect between customer priorities and the existing business design. And there can be multiple reasons for the same, like cost, convenience, innovation, technology, lower switching cost, and ease of access to funding. I will give a couple of examples. Like 20 years back, we used to have some banking requirement. At that time, trust was the only probably deciding factor. You were giving your money to banks and you wanted to have as and when you require. Over a period of time, it has changed because of technology, new product innovation, convenience. Now, those are the things being offered by, say, private banks, even better rated NBFC or best of the PSUs as well. So, spectrum is changing. And this changing dynamics are favoring certain companies or the better rated NBFCs. And this change is quite structural. This is one of the examples like how the value migration is helping to grow a particular sector much ahead of the underlying economy growth. And within that sector, there will be certain companies which will emerge as a winner. So as a theme, we want to come across the say sectors which are going to benefit in next decade, where the growth profile will be much superior to the underlying economy growth. And within that particular sector, which are the company which should do well. So we have zeroed in 5 themes. Number 1, the consumption. It is anchor for India growth story because private consumption account for almost 60% of the GDP and should likely to remain anchor for India growth. There are the companies in the consumer sector which should benefit from increase in penetration rates, per capita consumption, urbanization, shift from unorganized to organized, and premiumization. When we think about any opportunity, we think in terms of compounding. So jewelry if we think from the sector perspective, we love jewelry. Always the question is who is going to serve that particular demand. So you will agree that in last 20 years, the mobility factor has increased quite a lot. People are moving from one city to another in order to get whatever the opportunities available to them. At the same time, need exists. People want to have a contemporary design, peace of mind, quality, convenience, uniform terms and condition. And in that particular situation, Titan fits the bill. So unorganized to organized transition is happening. So organized players are growing at much faster rate than the overall underlying jewelry growth. And within that, Titan has done much better. We do believe it should continue. So this is one of the example, like how we are picking any name in any particular area. So within consumption, it may be something like Titan, or say it may be like Radico Khitan. Another big theme is like financials. So any economy does require a sound financial system. As I highlighted earlier, that 20 years back, it was all about trust, which is being earned by, say, private banks, better rated NBFCs. And they are also bringing on table, say, convenience part, new products, technology. And that's the reason these better and more efficient banks and NBFCs are gaining higher market share. So despite they might be only 1/3 of the overall credit outstanding, they are garnering much higher incremental credit share. And that's the reason companies like SDFC Bank, ICICI Bank have delivered much faster loan growth vis-a-vis the underlying system growth. And we do believe this trend should also continue. So this is another theme where we are sourcing a decent proportion for our portfolio. When we think about consumption and financials, these were the traditional opportunities available even in the pre-COVID scenario. COVID provided an opportunity in disguise, like chemical sector. So India is having close to 4% market share in specialty chemical. So chemical market itself will be having a reasonable growth globally. And we have an opportunity to outpace that growth because there is factor like China +1 and there is factor like Western Europe +1. Put together, they are almost 40% of the overall market globally. And China and India is just fraction of it. So a shift from a market share from, say, China and Western Europe to India, along with the underlying growth in the chemical sector, provide structural tailwind to this particular sector. These are the opportunities emerging in the post-COVID scenario. So this is another big theme over which we are sourcing a decent number and reasonable exposure in the chemical sector. Fourth is like PLI, CapEx, manufacturing, where there's significant thrust. We do believe that manufacturing contribution to GDP has bottomed out, and in time to come, manufacturing will be a big lever or driver for the overall economic growth in our country. Government has announced multiple PLI schemes and trying its level best to have CapEx push. If you would have noticed in the recent budget as well, there was almost 35% increase on the CapEx side. So manufacturing will be another area where there will be multiple opportunities coming our way. And that particular area will also be growing at much faster clip vis-a-vis, say, underlying economic growth. Fifth theme is like digitization. So again, during the COVID time, say digitization process increased or accelerated because we were able to deliver on our SLAs despite people working from home. And when it's happening, it's not only providing say traditional IT services opportunity, it's providing accelerated opportunity from area like cloud software. And if there is higher spending happening in that particular area, Indian companies should do better. And this is one of the themes which should continue to provide, say, support to not only our portfolio, it does support the overall trade balance as well, which we discussed in past. So it's quite an important sector overall. So these are the 5 themes from where we have sourced our most of the portfolio. So consumption is almost 31% of the portfolio. When we say consumption, it includes retail, consumer durable, staples, beverages, building products, discretionary, because we believe that this is the area which should continue to do well for next 5 to 10 years as well. And it's a little bit more steady, consistent growth. And if we think about the consumption overall, we believe that if the incomes are increasing, people having surplus, they will be probably investing more on the discretionary side. So the large part of the say consumption exposure is in the discretionary side. As we discussed about financial, almost 30% portfolio is coming from the financial side, like NBFC, banks, general insurance. We have tried to have decent exposures in those areas. Third thing, like platform, software services, telecom, account for another 12 to 13%. Chemical, as we discussed, is structural opportunity available to us. And in combination with the API pharma, almost 14 to 15% exposure coming. Manufacturing is big opportunity from next 10-year perspective. And that's why we are having decent exposure in that particular area as well. If we look, say, overall psychographic, then earning growth is likely to be 23% in FY23. And it should continue that way even next year as well. This is where we differentiate our offering vis-a-vis, say, market. Like we are focused in the area of high quality, high growth. So in last 5 years as well, our portfolio earning growth would have been more than 20% CAGR. And we believe this trend should continue for years to come. And despite the tough macro environment, challenging environment in the domestic arena or globally, our portfolios are delivering good earning growth. Like in Q3 as well, like operating profit growth was 20% plus, vis-a-vis say Nifty operating profit growth of 12%. If we think about FY23, operating profit growth for the portfolio would be 17% plus, vis-a-vis say market growth of close to 14%. Next year, again, there should be significant delta over the market growth in FY24. ASK Vision portfolio performance can be seen in two parts. If we look CY20 and CY21, portfolio delivered close to 24% CAGR, vis-a-vis say BSE 500 close to 24% and Nifty 19%. Last year was a difficult year, and it should be seen in two parts, like what has worked for the benchmark and what has not worked for us. When we analyze the same, we realize that public sector banks or utilities have done quite well, which contributed to the BSE 500 performance. We are not present in those areas because we believe that for sustainable value creation, the destiny should be in the hand of the people who are running the business, where the regulatory intervention is either not there or quite low. And our companies, despite delivering good earnings, there was not a translation of the same into the stock return. We do believe it's an opportunity because if we look India's own history of last 30 years, on headline basis, India would have delivered 12% nominal GDP growth CAGR, 12% earning growth CAGR, and 12% stock return CAGR. But linear relationship does not exist on every time. There are the time periods where the earning growth will be relatively higher, stock returns may be relatively lower, and so on. But from 5-year perspective, there is high likelihood that there will be convergence of earning growth and the stock returns. So if fundamentals are in place, earning growth is coming. At the same time, stock market has not rewarded the earnings so far. Probably there is high probability that in future, the earnings translation into the stock return may be relatively more superior. So where we focus on? We focus on that our companies, our portfolio should keep on delivering the good earning growth, fundamentals should remain intact. And if it does happen, then probably in time to come, there should be a decent translation of the same into the overall portfolio return as well. I will stop over here and we'll be happy to have any question which you might be having.
Thank you, Kuldeep, for the portfolio positioning, and you covered up about some of the questions which is coming in the chart box or the performance perspective point of view. Participants, we request you to keep on chatting your questions in the chat box or in the Q&A. So we will be passing to the questions then. So Kuldeep, a couple of questions which has come. I will segregated. I kept it ready. So one by one I'll go. So we can just give it the answer on those things. The first question, and considering the inflation is picking up, I think most of the countries, including the India, also have keeping on the interest rates high. At the same time, the possibility of the fear of recession, which combination of these things, and the question which has come, will it affect the consumer durable sector and consumption sector in India? If it is yes, how you are taking an action on the portfolio? Is the first question has come.
So if we think about from India's own positioning perspective, I would say we had a good appreciation of the macroeconomic challenges. So we already have 10-year bond yield close to 7.4%, which is higher than the inflation. So incremental, say, impact of the either inflation on the interest rate side should look lower. As I mentioned that our own domestic factors are doing good, and there are not so many challenges if we think about India in isolation. So multiple tailwinds are available, which should keep India's story intact. And if it does happen, then probably we are better placed to have decent or steady consumption growth pattern. And within that, the discussion should also continue to do well. The challenge can happen, like in recent times, there had been factors like El Nino being discussed. So if it becomes a reality, if there is shortfall on the agri output, then the response of the government will matter, like what is the increase in the MSP prices, what are the subsidies being provided. All that will lead to certain inflation outcome. If we look historically, whenever this factor has played out, probably inflation was not that big a problem, but only time will tell. Probably we will be having better clarity next month that the intensity of the challenge and the response to the same. If the situation remains the way it appears as of now, that when we are talking about close to 15% earning growth for the corporates overall in FY24, we do believe that discretionary should do reasonably well. Last year, there were challenges on the commodity side, like inflation was high, which impacted the margins and so on. Those challenges have actually come down, and it should provide some tailwinds to the margin overall. So net, I would say, unless some extreme situation happen here onwards, it should remain, or discretionary consumption or overall consumption should remain in a decent shape.
Thank you, Kuldeep. So the second question which has come, I have invested in ASK India Vision Portfolio for the 5 years horizon period, which I've already completed almost 3 years, 2 months. Can we, the investment, the expectation was to generate a double-digit return. Considering the lot of events are happening in the global, and the remaining 2 years of my investment period, can I able to beat the returns on the double-digit growth?
So, as I mentioned, that first principle or first requirement to have double-digit return is that the earnings should come in a pretty good shape, and this is something happening for our portfolio. As I mentioned, like despite a lot of challenges, Q3 FY23 had 20% operating profit growth, and year overall we expect more than 20% EPS growth. Next year as well, 25% EPS growth. As I mentioned, that there is not one-to-one relationship in short term. There can be multiple noises. The way it happened in last 1 year, that whether it's a COVID to Russia, Ukraine, high inflation, high interest rate, and so on, which led to a situation that earning growth did not translate into the good stock return. But as long as we believe that economy growth intact, corporate earnings growth quite decent, and within that we are trying to figure out the companies which can deliver earning growth more than 20% CAGR, then we should be in a decent shape. Like incremental EPS growth should translate into decent stock return when we think about next 2 to 3 year perspective.
In India Vision portfolio, one of the customers is asking, the few stocks like APL Apollo, Polycap, as some of the stocks has done pretty very well. But at the same time, Aster Poly, Sona Comstar, and Dixon has dragging the performance of the entire portfolio. So what is the way forward and course of action on these stocks?
So we will have to analyze the reasons why the stock did not do well last year. So Sona BLW did not do well for the reasons that it sourced almost 25% of the revenue from Europe and China, additional 40% from North America. And in the Western Europe or say US side, narrative is that there will be slowdown and possibility of the recession as well. It does impact the short-term performance. But when we think about the Sona BLW opportunity, it's placed in an area where a lot of action will be happening in next 5 to 10 years. Like it's auto ancillary firm, which is providing, say, a differential gear, differential assemblies, and it's more representative of the change happening from internal combustion engine towards EV. As we speak, less than 30% will be coming from, say, EV platform for Sona BLW. When we analyze the order book of the company, which is quite healthy, like close to 20,000 crore order book, 2/3 coming from the EV. So they are placed in the area where the industry will be moving. And we do believe the company can deliver more than 20% earning growth for next 5 years. And if it happens, then after the current chain of events, when the narrative of slowdown and recession will be over in next 6 months or a year, probably there should be a decent performance coming from this particular name. Second is Dixon. Like Dixon is poster boy of the PLI incentive, PLI scheme which the government has provided. The company did quite well in last 5 years, like more than 30% operating profit CAGR. This year, there are a couple of segments which underperformed, like consumer electric and lighting, which declined. Mobile was below expectation. So they underperformed on the overall revenue perspective. At the year beginning, the expectation was that they will be delivering more than 16,000 crore revenue. Actual delivery is much lower, close to 12,500 to 13,000 crore in FY23. But we believe it's more like a blip in the overall story. And it should again pick up in time to come. Generally, whenever we think about, say, significant changes in the growth profile, it may not be smooth. There may be some times where there may be some aberration, some blip. But in our understanding, it will still remain on track to deliver decent earning growth for years to come. So despite having lower earning growth, lower revenue growth, the company is bound to deliver more than 30% operating profit growth even in this year, and next year it should accelerate. So again, FY23 was a difficult year for the company. It should change in time to come. Next, Astral. So in case of Astral, sometimes company do suffer because they are relatively better placed to deal with the difficult situation. This is something happened in last year. So you will recall that last year beginning, everybody was talking about, say, commodity inflation. Astral is having good balance sheet. They had, say, relatively higher cost inventory, they could do it because they had the balance sheet strength. So when the commodity prices corrected in the second half, they couldn't benefit out of it. And this should change in coming quarters and the next year. So whatever we have seen from, say, below par operating performance, again, this was one time in our view, and it should change in about 24 or years to come as well. So if we look the Astral own history, like last 5 years, Astral would have delivered close to 25% plus PBT growth. And if we exclude FY23, we believe that this company can still deliver, say, 15 to 20% earning CAGR for many years to come. So again, FY23 was aberration for Astral. So these are the names which pull down not only the operating performance for the portfolio, as well as, say, overall portfolio return in FY23. As and when these companies start delivering decent results in FY24 or beyond, it should also translate into the good return overall.
Thank you, Kuldeep, for the detail stock wise. The fourth question, which has come from the especially on the chemical sector, in our India Vision portfolio, we have almost near to 12% of the weightage in the chemical sector. Despite of the decent earnings, which is last 2 quarters has come from these companies, why stocks has been underperforming, and is there any internal problems in these companies, which is one of the question has come from one of the customers.
So as I mentioned, like prior to COVID, this sector used to be considered a commodity sector, working more on the spreads, like how the global demand and supply is working. Post-COVID, a lot has changed. Long-term contracts are coming, and there's a lot more visibility from the earning growth perspective. So whether it's Naveen, Fluorine, SRF, they are supposed to give decent earning growth. At the same time, like this sector is export-led sector, and their clients might be in Europe and other geographies. And we know there are the challenges in those geographies. So end user demand did suffer, which had some supply chain implication for these companies. We believe that it's a boon in disguise, like these short-term challenges may lead to some underperformance, both on operating side as well as stock return side. But the shift, 3 years back, we were talking about only China +1. Today, we are also talking about Western Europe +1. So while we may have near-term pain, from long-term perspective, a lot more opportunities are available for this particular sector. And that's the reason we are a lot more confident that earning growth trajectory will be much ahead of the underlying broader market growth in our country. And when it will be happening, there is high likelihood that they will be significant contributor to the overall portfolio return as well.
Thank you, Kuldeep. One of the common question which is coming is the major portion of the stocks are India Vision portfolio are high PE in terms of the measuring of the valuations. Is that the reason last 1 year underperformance the benchmark? How you are looking at this point?
So, like if we think about valuation, first we should think about the opportunities available. So in our country, though there are 5,000, 6,000 listed companies, but when we start applying the various filters, like the companies in the right sectors, companies which have the good management, corporate governance practices, having high return on capital employed, when we apply the, say, the India Vision specific filters like earning growth more than 20% and return on capital employed more than 25%. We have actually less than 100 companies to choose from. And what happens, like when there are many events happening, like if you look last 5-6 years, in 2016 we had concern about demonetization. 2017 we had concern about GST related disruption. 2018 beginning, it was more about trade wars. 2018 and ILFS issues. 2019 general election, 2020 COVID-1, 2022 we had this Russia-Ukraine, now inflation, interest rate. So what we are observing that events are happening on regular interval. Source may be local or global, impact will be smaller or bigger, but issues are happening. It's leading to a situation that everybody has become quite short-term focused. So where the near-term earning are marginally ahead of, say, expectation, market is rewarding the same. When the things looks cheaper on nominal basis, then say there is attraction for the same, that it's a relatively lower valuation in the tough environment, and the combination of the optically cheap valuation and earning growth led to decent performance for many stocks last year. But sustainability is the key. When we think about, say, 3-year, 5-year perspective, we do believe in an emerging economy like India, growth is always going to command premium, because those are the sector, those are the companies which are aligned to the prospects of this country. And there are very few companies and the management who have the track record of delivering earnings year after year on the compounding manner. So I will take it positively that the companies of that character, despite delivering earnings on a consistent basis, have actually either not delivered stock return in short term, or they have corrected. Now it become a quite attractive combination that we have reasonable or strong earning growth prospects from medium to long term perspective, at the same time at reasonable valuation. And please understand, if value part of the market is doing well and growth is not doing well, the gap between these two significantly come down. And when we think about, say, next 5-year perspective, there is high likelihood that if the growth companies continue to deliver, then it will translate into decent return as well. So multiple de-rating has definitely happened in last 1.5 years, which is actually an opportunity to buy the names where otherwise we pay significant premium.
Thank you, Kuldeep. One more common question is coming, which you explained as a partly in the when they come to the performance perspective point. The 1-year basis and 2-year basis and 3-year basis, they combined even the IEP also, India Vision also. So IEP will keep it aside here as a India Vision in the period of 1 and 2 and 3 years perspective point, they could not able to beat the benchmark in as explained. But what are the corrective measures are you taking to beat the benchmark over the couple of years?
So, as I mentioned, like till CY21, things were looking decent. In CY22, two things happened. Like BSE 500 did better for the reasons I already articulated. That PSU pack, which is almost 9% of the benchmark, delivered 20% plus stock return, which accounted for almost 40% return being generated by the benchmark. Going forward, that part will have to deliver consistent earning at a reasonable pace to have incremental delta. So benchmark had certain factor which did not work in past, and probably CY22, many things fall in place, and that happened. As far as India Vision is concerned, I highlighted that there are 3-4 names like whether Sona BLW, Dixon, Divis, or Astral. Those companies did not perform well, despite they are structural winners when we think about long-term perspective. So FY23 was difficult year from the operating performance perspective for these companies. It should change in coming years. And if it happens, then they should again start contributing to the overall portfolio return as well. So from our perspective, there had been many one-off reasons which ideally should not repeat in coming years. And same holds true for the benchmark as well. There are things which work, and sustainability will be the key. And we will have to see that how long that can be doable. So both the aspects, like benchmark, certain things working, and for us, certain things not working at FY23. We do believe it was more of an aberration rather than a norm.
Thank you, Kuldeep. Last two questions which has been there. One, what is the in terms of the reason to exit or the hours of financial stock in the portfolio?
So the stock did not do well for us, and otherwise earning growth had been reasonable. And it's all about taking exposure towards other name where we are a little bit more confident about both earning growth and its translation into the stock return. Otherwise, it's a good company in the structural area. So only the stock was not doing well, and we come across other names where the money could be deployed.
Excellent. Last one question which is there. One of the existing customer is asking the question: do you feel that this is the right time to add money in the same portfolio, or should you wait for further correction in the portfolio? So what is your advice to us?
So as I mentioned in the beginning, that there is a lot of noise in the overall system, whether it's challenges in the global macro environment, or say even in our own situation, we are talking about El Nino, where it can have some implication for consumption and so on. So there can be a situation that things may remain volatile, but at the same time, say if the valuation have corrected, earnings growth are coming, then staggered investment is the right way to go about. And what we are dealing as of now, it's more of a financial issues like inflation, interest rate. We have dealt similar issues in 2018. We have dealt similar issues in 2013 and 2008. So what we are dealing with is something in one shape or in one form or another in past as well. Even in 2020, a COVID year, when stock market corrected significantly during March 20, that was more of an existential crisis. At that time, it appeared that it's a doomsday scenario, things will not come back. But April 20 onwards started moving in a right direction, and there was no looking back. So 2020 was something which probably we have not seen in generations, once in a lifetime thing. Even then, the stock market overcome that particular issue and move northward. Today, what we are experiencing, it's more of a financial issue, financial crisis, one way or another. We are used to dealing with the same. It may be around for 6 months or a year, but it should be taken as an opportunity rather than threat. And when there is uncertainty around, probably staggered investment may be the right way to go about it.
Thank you, Kuldeep. There's no questions in the chat box. We would like to end the program here. Thank you for the participants coming on this call, and thank you, Kuldeep, for your time to explain about the position of the portfolio and a lot of the questions which you answered it. Thank you. Have a great weekend.
Thanks, everyone. Thanks a lot.